Question 1. Which of the following is a non-forfeiture option commonly available in long-term care insurance policies? A. Restoration of benefits. B. Reduced paid-up insurance. C. Waiver of premium. D. Benefit trigger. Answer: B. Reduced paid-up insurance. Explanation: non-forfeiture options are features that allow a policyholder to retain some level of coverage if they stop paying premiums. Reduced paid-up insurance is a common non-forfeiture option where the policyholder retains a reduced benefit level without having to pay further premiums. In contrast, options like restoration of benefits, which reinstates benefits after they've been used, and waiver of premium, which waives premium payments during benefit periods, do not fall under non-forfeiture options. Benefit trigger refers to events that must occur to activate policy benefits and is unrelated to non-forfeiture. Under Michigan law, insurers must offer non-forfeiture benefits to protect consumers who can no longer pay their premiums, ensuring policyholders do not lose all their invested premiums when they need coverage the most. Question 2, scenario-based. Mr. Lawson, aged 67, recently purchased a long-term care insurance policy with a 90-day elimination period and a maximum daily benefit of $200. He was diagnosed with a cognitive impairment that qualifies him for benefits. He began receiving in-home care services valued at $150 per day, but paid out of pocket for the first 90 days of care. After the elimination period, what will happen next regarding Mr. Lawson's long-term care policy payments? A. The insurance company will reimburse him for the first 90 days of care. B. The insurance company will start paying $200 per day for care from day 90 on. C. Mr. Lawson will continue paying $150 per day until he hits his lifetime maximum benefit. D. The insurance company will reimburse $150 per day starting from day 90 on. Answer: D. The insurance company will reimburse $150 per day starting from day 90 on. Explanation: Mr. Lawson's policy has a 90-day elimination period, which means he is responsible for paying out of pocket for care during this period. After the 90 days, the insurance company begins paying for eligible long-term care services, but only up to the daily maximum benefit of $200. Since his care costs $150 per day, below the daily maximum, the insurer will reimburse him for the full $150 per day starting from day 90 on. The insurer is not obligated to reimburse him for the care costs during the elimination period. Michigan's regulations ensure that long-term care insurance policies clearly outline the elimination period, benefit amounts, and reimbursement methods, making it essential for consumers to understand their policy provisions when seeking coverage for care. Question 3. Which of the following accurately describes the Medicaid asset spend-down rules in Michigan as they relate to long-term care? A. Medicaid covers all long-term care expenses without requiring asset spend-down. B. Individuals must deplete most of their assets to a specific threshold to qualify for Medicaid long-term care coverage. C. Medicaid spend-down rules allow individuals to retain up to $500,000 in liquid assets while qualifying for benefits. D. Assets in irrevocable trusts are exempt from Medicaid spend-down requirements. Answer: B. Individuals must deplete most of their assets to a specific threshold to qualify for Medicaid long-term care coverage. Explanation: Under Medicaid asset spend-down rules, individuals must reduce their countable assets to a specific threshold to qualify for Medicaid's long-term care benefits. In Michigan, individuals are typically allowed to keep certain exempt assets, such as a primary residence and a limited amount of personal property, but most liquid assets must be depleted to qualify. The statement that Medicaid covers all expenses without asset spend-down is incorrect, as Medicaid has stringent financial eligibility requirements. The $500,000 threshold C is not accurate. In Michigan, the actual limit is much lower for liquid assets. Irrevocable trusts D can sometimes be exempt, but this depends on specific rules, and not all irrevocable trusts automatically protect assets from Medicaid spend-down requirements. Michigan's Medicaid asset rules are designed to ensure that only those with financial need receive Medicaid support for long-term care, while also providing strategies for asset protection through proper planning. Question 4. Which of the following is a key eligibility requirement for receiving long-term care benefits under a qualified long-term care insurance policy? A. Inability to perform 4 of the 6 activities of daily living adults. B. Diagnosis of any chronic medical condition. C. Inability to perform 2 of the 6 activities of daily living adults. D. Age 65 or older. Answer: C. Inability to perform 2 of the 6 activities of daily living adults. Explanation: A qualified long-term care insurance policy typically requires that the insured be unable to perform at least two of the 6A DLS: bathing, dressing, eating, transferring, toileting, and continence for a specified period to qualify for benefits. This is part of the benefit triggers. In contrast, requiring the inability to perform 4 of the 6A DLS would set a much higher threshold and is not typical in standard long-term care insurance. A simple diagnosis of a chronic condition, B, does not automatically qualify someone for benefits unless it impacts a DLS or cognitive functioning. Age alone, D, is not a trigger for eligibility. Michigan regulations follow federal standards under HIPAA, which establish these DL thresholds for tax-qualified long-term care policies. Question 5, scenario-based. MS. Collins, aged 72, has a long-term care insurance policy with a shared care rider that she purchased with her spouse. Her husband passed away after using a significant portion of his policy benefits. Now MS. Collins is concerned about her coverage. What does the shared care rider allow MS? Collins to do in this situation? A. MS. Collins will lose access to the unused portion of her husband's benefits. B. MS. Collins can access the remaining benefits from her husband's policy to extend her own coverage. C. The shared care rider applies only to nursing home coverage, not in-home care. D. MS. Collins will be required to pay additional premiums to access her husband's benefits. Answer. B. MS. Collins can access the remaining benefits from her husband's policy to extend her own coverage. Explanation. A shared care rider allows couples to share their pool of benefits. If one spouse passes away after using part of the benefits, the surviving spouse can access any unused portion. This rider is designed to provide flexibility and peace of mind for couples, ensuring that the surviving spouse has additional resources for long-term care if needed. In MS. Collins' case, she would not lose access to the remaining benefits, A, and no additional premiums are required. D. The shared care rider generally applies to all types of long-term care covered by the policy, including nursing home and in-home care, making C incorrect. In Michigan, insurers must clearly disclose the terms of shared care riders, including how the remaining benefits are accessed and any limits that apply. Question 6. Which of the following is true regarding inflation protection in long-term care insurance policies? A. Inflation protection increases the daily benefit based on a fixed percentage regardless of policyholder choice. B. Inflation protection options are mandatory in all long-term care policies sold in Michigan. C. Compound inflation protection increases the benefit annually by a fixed percentage on the previous year's benefit amount. D. Simple inflation protection increases the benefit annually by multiplying the benefit by a variable percentage based on inflation rates. Answer. C. Compound inflation protection increases the benefit annually by a fixed percentage on the previous year's benefit amount. Explanation. Compound inflation protection increases the benefit amount each year by a fixed percentage. G. 3% or 5% based on the previous year's benefit, which results in exponential growth over time. Simple inflation protection. D. Increases the benefit by a fixed percentage each year, but based on the original benefit amount rather than the current year's benefit. Inflation protection options, B, are not mandatory, but insurers are required to offer them in Michigan. Inflation protection does not automatically increase benefits unless the policyholder opts for it, making option A incorrect. Inflation protection is crucial for long-term care insurance since the cost of care typically rises over time. Michigan's regulations ensure that policyholders are offered inflation protection to preserve the value of their benefits against rising care costs. Question 7. Which of the following best describes the relationship between Medicare and long-term care insurance? A. Medicare provides comprehensive coverage for long-term care services, including custodial care. B. Medicare only covers skilled nursing care and rehabilitative services after a hospital stay for a limited duration. C. Medicare covers all home health care services for long-term care needs. D. Medicare provides ongoing coverage for long-term care for individuals over the age of 65. Answer. B. Medicare only covers skilled nursing care and rehabilitative services after a hospital stay for a limited duration. Explanation. Medicare does not provide comprehensive coverage for long-term care, particularly for custodial care, help with adults. It primarily covers short-term, skilled nursing care and rehabilitative services following a hospital stay of at least 3 days, and even then, coverage is limited to 100 days. After that, the individual is responsible for costs. Medicare does cover some home health services, but only if they are medically necessary and prescribed by a doctor, and not all long-term care needs. C. Medicare does not offer ongoing coverage for long-term care services. D. In custodial care is typically the responsibility of the individual or covered by private insurance. Michigan's regulations ensure that long-term care insurance complements Medicare by filling the gaps where Medicare does not provide adequate coverage. Question 8. Which of the following is a prohibited sales practice in Michigan's long-term care insurance market? A. Using cold calling to generate leads for long-term care insurance sales. B. Comparing multiple policies to help the consumer make an informed decision. C. Replacing a consumer's existing policy without verifying its suitability. D. Using clear disclosures in advertising to explain policy benefits. Answer: C. Replacing a consumer's existing policy without verifying its suitability. Explanation: it is illegal to replace a consumer's long-term care insurance policy without ensuring that the new policy is suitable for their needs. Michigan's suitability standards require agents to thoroughly assess whether the replacement policy provides better benefits or features. Cold calling, although restricted in some contexts, is not outright prohibited if done in compliance with regulations. Providing policy comparisons, B, and clear disclosures, D, are considered best practices and are encouraged to help consumers make informed decisions. Michigan's insurance regulations protect consumers from unethical practices, ensuring agents prioritize the suitability and transparency of long-term care policies. Question 9, scenario-based. Mrs. Davis, age 80, has been receiving care in an assisted living facility for the past 18 months. She initially had a 3-year benefit period with her long-term care insurance policy, and her maximum daily benefit is $250. After review, the insurer finds that she still requires care but has exhausted most of her policy benefits. What might happen next? A. Mrs. Davis will continue to receive full benefits for as long as she needs care. B. Mrs. Davis will be required to pay for her care out of pocket once her policy benefits run out. C. The insurer will increase her benefit period automatically based on her current needs. D. Mrs. Davis is eligible for government assistance through Medicare after her insurance expires. Answer: B. Mrs. Davis will be required to pay for her care out of pocket once her policy benefits run out. Explanation: long-term care insurance policies typically have defined benefit periods, such as 3 years, and once those benefits are exhausted, the policy no longer provides coverage. Mrs. Davis would need to pay for her care out of pocket after the policy benefits are depleted. Insurers do not automatically extend benefit periods. C. And Medicare does not cover long-term custodial care. D. Mrs. Davis may need to explore other options such as Medicaid if she qualifies, but Medicaid has strict eligibility requirements based on income and assets. Michigan requires insurers to clearly outline benefit limits in long-term care policies, and policyholders must plan for the possibility of out-of-pocket costs once those benefits are used. Question 10. Which of the following is a tax advantage of a qualified long-term care insurance policy under federal guidelines? A. All premiums paid are tax deductible regardless of the policyholder's income. B. Premiums paid for a qualified long-term care policy may be tax deductible up to certain limits based on the policyholder's age. C. Benefits received under a qualified long-term care policy are considered taxable income. D. Long-term care insurance benefits reduce the amount of medical expenses eligible for deduction. Answer: B. Premiums paid for a qualified long-term care policy may be tax deductible up to certain limits based on the policyholder's age. Explanation: under federal tax rules, premiums paid for qualified long-term care insurance policies may be tax deductible as medical expenses, but the amount deductible depends on the policyholder's age and income. There are specific limits set by the IRS based on the policyholder's age group. Benefits received under these policies are generally not taxable. C. And they do not reduce other medical deductions. D. The deductibility of premiums is not automatic and is subject to certain income thresholds. Michigan follows federal tax guidelines and allows policyholders of qualified long-term care insurance to take advantage of these tax benefits. Question 11. Which of the following best defines non-forfeiture benefits in long-term care insurance? A. A feature that guarantees policyholders a refund of all premiums paid after 10 years. B. A rider that provides partial benefits if the policy lapses due to non-payment of premiums. C. An optional benefit that increases coverage without increasing premiums. D. A benefit that applies only if the policyholder cancels the policy within the first 2 years. Answer: B. A rider that provides partial benefits if the policy lapses due to non-payment of premiums. Explanation: non-forfeiture benefits protect policyholders by ensuring they still receive partial benefits even if they can no longer pay premiums and the policy lapses. This benefit does not guarantee a full refund of premiums, but typically provides either reduced benefit or a return of a portion of paid premiums. Option C is incorrect, as non-forfeiture benefits do not increase coverage without increasing premiums. Option D is incorrect, as the benefit is not limited to a specific cancellation period. Question 12. Under Michigan law, what is the free look period for long-term care insurance policies during which a policyholder can return the policy for a full refund? A. 10 days. B. 30 days. C. 45 days. D. 60 days. Answer: B. 30 days. Explanation: the free look period for long-term care insurance policies in Michigan is 30 days. During this time, a policyholder can review the policy and return it for a full refund if they are not satisfied with the terms. This consumer protection is important to ensure individuals have enough time to understand the complexities of long-term care insurance before committing. Question 13. Which of the following is not typically covered under standard long-term care insurance policy? A. Assisted living facility costs. B. Adult day care services. C. Medical care provided by a physician. D. Home health care services. Answer: C. Medical care provided by a physician. Explanation: standard long-term care insurance policies are designed to cover custodial care, such as assistance with activities of daily living adults in a variety of settings like assisted living, adult daycare, and home health care. However, medical care provided by a physician C is typically covered by health insurance or Medicare, not long-term care insurance, which focuses more on non-medical custodial care. Question 14. Scenario-based. Mr. Thompson has a long-term care insurance policy with a 90-day elimination period and a $200 daily benefit. He recently entered a nursing home and stayed for 150 days. How many days of benefits will the policy pay, and how much will Mr. Thompson receive in total? A. 60 days at $12,000. B. 90 days at $18,000. C. 150 days at $30,000. D. 150 days at $12,000. Answer A. 60 days at $12,000. Explanation: an elimination period is the waiting period during which the policyholder is responsible for paying for care out of pocket before the insurance benefits kick in. Mr. Thompson's 90-day elimination period means that the policy will only start paying benefits after he has paid for the first 90 days of care. He stayed for 150 days, so the policy will cover the remaining 60 days at $200 per day, totaling $12,000 in benefits. Question 15. What is the primary purpose of a partnership long-term care insurance policy? A. To provide low premiums for individuals with pre-existing conditions. B. To allow policyholders to protect assets from Medicaid spend-down requirements. C. To offer unlimited benefits for long-term care. D. To combine long-term care coverage with life insurance benefits. Answer: B. To allow policyholders to protect assets from Medicaid spend-down requirements. Explanation: a partnership long-term care insurance policy allows policyholders to protect a portion of their assets from Medicaid spend-down requirements if they need to apply for Medicaid after exhausting their policy benefits. This type of policy encourages individuals to purchase private long-term care insurance while offering the potential for Medicaid asset protection. It does not provide low premiums A, unlimited benefits C, or life insurance benefits D. Question 16. Which of the following is true about tax-qualified long-term care insurance policies? A. Premiums are never tax-deductible. B. Benefits received from a tax-qualified policy are considered taxable income. C. Premiums may be tax-deductible depending on age and other factors. D. Tax-qualified policies only cover care provided in a nursing home. Answer: C. Premiums may be tax-deductible depending on age and other factors. Explanation: premiums for tax-qualified long-term care insurance policies may be deductible as medical expenses on federal tax returns, subject to age-based limits and other criteria. The benefits received are generally not taxable. B. And tax-qualified policies cover a wide range of care settings, not just nursing homes. D. Question 17. Under Michigan law, which of the following is a requirement for long-term care insurance agents when selling policies? A. Agents must provide a full medical examination for applicants. B. Agents must provide a personal worksheet to assess the suitability of the policy for the client. C. Agents are prohibited from discussing Medicaid with clients. D. Agents must automatically provide inflation protection riders. Answer: B. Agents must provide a personal worksheet to assess the suitability of the policy for the client. Explanation: Michigan law requires long-term care insurance agents to provide a personal worksheet to help assess whether the policy is suitable for the client's financial situation and long-term care needs. This worksheet helps ensure that the policyholder can afford the premiums and that the policy aligns with their care expectations. Agents are not responsible for conducting medical exams and are not prohibited from discussing Medicaid. C. Though they must avoid giving legal advice. Inflation protection riders D. are not automatic but must be offered. Question 18. Which of the following best describes a contingent non-forfeiture benefit? A. It provides full coverage without the need to pay premiums if the policyholder becomes disabled. B. It applies if premiums increase by a certain percentage, allowing the policyholder to stop paying premiums while still retaining some benefits. C. It allows the policyholder to borrow against the policy's cash value. D. It provides additional coverage if the policyholder dies while receiving care. Answer: B. It applies if premiums increase by a certain percentage, allowing the policyholder to stop paying premiums while still retaining some benefits. Explanation: A contingent non-forfeiture benefit allows policyholders to retain partial benefits if the insurance company raises premiums beyond a certain threshold and the policyholder can no longer afford to pay. This ensures that the policyholder doesn't lose coverage entirely due to premium increases. It does not provide full coverage without paying premiums and is not related to borrowing against cash value C or death benefits D. Question 19. What is the key difference between guaranteed renewable and non-cancelable long-term care insurance policies? A. Guaranteed renewable policies can be cancelled by the insurer if the insured's health worsens. B. Non-cancelable policies guarantee the policyholder can never be dropped or have premiums raised. C. Guaranteed renewable policies allow for inflation adjustments without premium increases. D. Non-cancelable policies allow the insurer to raise premiums but guarantee renewal. Answer: B. Non-cancelable policies guarantee the policyholder can never be dropped or have premiums raised. Explanation: Non-cancelable long-term care insurance policies guarantee that the policyholder cannot be dropped and that premiums will not increase as long as they continue to pay them. Guaranteed renewable policies ensure that the policyholder cannot be dropped, but the insurer may still raise premiums for an entire class of policyholders, not based on individual health changes. Inflation adjustments C are separate from the renewability of the policy. Question 20. Which of the following is not a reason why long-term care insurance premiums might increase? A. The insured turns 65 years old. B. Insurers receive approval for premium rate increases from state regulators. C. Rising healthcare costs outpace initial premium calculations. D. The insurer increases premiums for an entire class of policyholders based on claims experience. Answer: A. The insured turns 65 years old. Explanation: Long-term care insurance premiums are typically based on the age at which the policy is purchased, and turning 65 does not trigger an automatic premium increase. However, premiums may increase if insurers seek and receive approval for rate increases. B. If healthcare costs rise faster than expected. C. Or if the insurer raises premiums for a group of policyholders based on claims experience. D. Question 21. What is the primary purpose of an inflation protection rider in a long-term care insurance policy? A. To ensure that the policyholder's premiums do not increase over time. B. To increase the daily benefit amount over time to keep pace with rising costs of care. C. To provide coverage for additional types of services not initially included in the policy. D. To guarantee that the policyholder can change their coverage without medical underwriting. Answer: B. To increase the daily benefit amount over time to keep pace with rising costs of care. Explanation: An inflation protection rider is designed to increase the daily benefit amount of the long-term care insurance policy over time, helping to ensure that the benefits keep pace with the rising costs of long-term care. This is important because the cost of care can increase significantly over time, and inflation protection helps maintain the policy's value. It does not prevent premium increases. They provide additional services. C. Or guarantee coverage changes without underwriting. D. Question 22. In which situation would a waiver of premium benefit typically be activated in a long-term care insurance policy? A. The policyholder is hospitalized for 30 days. B. The policyholder is unable to perform at least 2 activities of daily living adults. C. The policyholder reaches the age of 70. D. The policyholder is diagnosed with a chronic illness. Answer: B. The policyholder is unable to perform at least 2 activities of daily living adults. Explanation: a waiver of premium benefit allows policyholders to stop paying premiums while receiving benefits if they are unable to perform a specified number of a DLS, typically 2 or more. This feature is crucial for individuals needing care as it alleviates the financial burden of premium payments during periods of incapacity. It is not triggered by hospitalization, A, age, C, or general chronic illness diagnosis, D, unless the inability to perform a DLS is present. Question 23. Which of the following is a key consideration when assessing the benefit period of a long-term care insurance policy? A. The maximum number of years the policy will pay benefits. B. The minimum age at which coverage begins. C. The total amount of premium payments required for the life of the policy. D. The conditions under which the policy can be renewed. Answer: A. The maximum number of years the policy will pay benefits. Explanation: the benefit period refers to the maximum duration for which a long-term care insurance policy will provide benefits after the elimination period is satisfied. It can range from a few years to a lifetime depending on the policy terms. This is a critical factor in determining the level of coverage provided. The minimum age for coverage, B. Premium payments, C. And renewal conditions, D. Are separate considerations. Question 24. Which of the following is a common exclusion in long-term care insurance policies? A. Care provided by family members. B. Respite care for caregivers. C. Custodial care in an assisted living facility. D. Home health care services provided by licensed professionals. Answer: A. Care provided by family members. Explanation: many long-term care insurance policies exclude benefits for care provided by family members, as this can be difficult to verify and regulate, while policies typically cover respite care, B. Custodial care in assisted living, C. And home health care services, D. Care from family members is usually not eligible for benefits. Question 25. Scenario-based. Mrs. Johnson has a long-term care insurance policy that pays a benefit of $150 per day after a 60-day elimination period. If she receives care for a total of 180 days, how much will she receive in benefits? A. $18,000. B. $27,000. C. $22,500. D. $16,500. Answer: B. $27,000. Explanation: Mrs. Johnson has a 60-day elimination period, which means she is responsible for the first 60 days of care costs. After that, her policy will pay $150 per day for the remaining 120 days, 180 total days, 60 elimination days. Therefore, her total benefit is $150 x 120 was $18,000. Question 26. What type of long-term care insurance policy allows for flexible premiums based on the policyholder's financial situation? A. Indemnity policy. B. Cash benefit policy. C. Adjustable premium policy. D. Short-term care policy. Answer: C. Adjustable premium policy. Explanation: an adjustable premium policy allows policyholders to change the amount of their premiums over time based on their financial situation. This flexibility can be beneficial for individuals whose income or financial situation varies. Indemnity policies: A. Provide fixed benefits regardless of the costs incurred. Cash benefit policies: B. Provide cash payments directly to policyholders. And short-term care policies: D. Typically have fixed premium structures. Question 27. Which of the following is typically considered an activity of daily living adult that long-term care insurance policies use to assess eligibility for benefits? A. Cooking. B. Shopping. C. Dressing. D. Using public transportation. Answer: C. Dressing. Explanation: activities of daily living adults include essential tasks that individuals typically perform daily to maintain their personal care and independence. Common ADLS recognized in long-term care insurance policies include bathing, dressing, eating, toileting, transferring, moving from bed to chair, and continence. Cooking, A. Shopping, B. And using public transportation, D. Are considered instrumental activities, but are not classified as adults. Question 28. Which of the following statements regarding exclusions in long-term care insurance policies is true? A. All policies have the same exclusions. B. Exclusions typically include pre-existing conditions. C. Exclusions can vary widely among different insurers. D. Exclusions are not allowed under state insurance regulations. Answer: C. Exclusions can vary widely among different insurers. Explanation: exclusions in long-term care insurance policies can vary significantly between insurers and policies. While many policies include common exclusions such as care for pre-existing conditions, B. Not all policies share the same exclusions. Additionally, state insurance regulations allow for specific exclusions, meaning they are permissible. D. As long as they comply with state laws. Question 29. Scenario-based. Tom purchased a long-term care insurance policy with a daily benefit of $250, a 30-day elimination period, and a benefit period of 5 years. If he incurs care costs for 4 years and 5 months, how much will he receive in total benefits? A. $455,000. B. $365,000. C. $292,500. D. $280,000. Answer A. $455,000. Explanation: Tom's policy has a daily benefit of $250 and a benefit period of 5 years, 1825 days. However, since there is a 30-day elimination period, he will receive benefits starting after those 30 days. The total number of days he will receive benefits is 1825 days. 30 equals 1795 days. Tom incurred care costs for 4 years and 5 months, which equals 1645 days. 4 equals LT 60 days plus 5 months equals 185 days. Therefore, he will receive benefits for 1645 days, totaling $250 x 1645 equals $411,250. Question 30. What type of long-term care insurance policy typically requires no health underwriting for eligibility? A. Guaranteed issue policy. B. Underwritten policy. C. Simplified issue policy. D. Hybrid policy. Answer A. Guaranteed issue policy. Explanation: a guaranteed issue long-term care insurance policy allows individuals to obtain coverage without undergoing any health underwriting, meaning they cannot be denied coverage due to pre-existing conditions or health status. Underwritten policies B. require health evaluations, and simplified issue policies C. may have limited health questions but still involve some underwriting. Hybrid policies D. typically combine long-term care benefits with life insurance but do not guarantee issue status.